Opendoor Technologies, ticker symbol OPEN, is currently trading at $7.28, reflecting a minor gain of 0.21% in today's session. But that small green number on your screen is profoundly deceptive. It suggests a calm, quiet day for a stock in a turbulent sector, but the reality beneath the surface is anything but calm. While the headline figure seems static, the intraday price action has been a fierce contest, with the stock charting a wide path between a low of $6.97 and a high of $7.79. This isn't the side of a stable stock finding its footing. It's the mark of a battleground where bulls and bears are locked in a conflict over the very soul of the company. And the forces driving this volatility have very little to do with the day-to-day chatter about real estate and far more to do with a fundamental crisis of faith in the iBuying business model itself, a model now facing the harsh glare of persistently high interest rates and an uncertain economic future. Most investors and market commentators who follow Opendoor are fixated on a single overarching question: when will the Federal Reserve finally lower mortgage rates? The prevailing narrative, the one you hear repeated across financial news and social media, is that a drop in rates will act as a panacea. It's seen as the trigger that will unlock housing affordability, reignite transaction volumes, and send shares of Open climbing back towards their former highs. This is the simple, hopeful story that has convinced many to hold onto their positions, patiently checking their Fidelity or Robinhood app, waiting for that signal from Jerome Powell. The expectation is that Opendoor is a coiled spring, ready to release as soon as the macroeconomic pressure eases. But what if this entire premise is flawed? What if the market's obsession with interest rates is causing it to overlook the more immediate and dangerous risks embedded within Opendoor's balance sheet? The truly critical story isn't about Fed policy in 6 months. It's about Opendoor's inventory turn rates, its ballooning holding costs per property, and whether its proprietary pricing algorithms have genuinely adapted to a housing market that no longer guarantees easy appreciation. Sophisticated traders on platforms like Interactive Brokers aren't just betting on rate cuts, they are scrutinizing the company's quarterly cash burn and contribution margins, and what they're seeing is creating the deep division reflected in today's volatile price action. Looking closer at today's trading, the swing from below $7 to nearly $7.80 on what appears to be average volume is significant. It indicates that every small piece of economic data, every subtle shift in bond yields, is being amplified in this stock. The price is struggling to hold above its previous close of $7.27, a key psychological level. A failure to maintain this footing could easily send it back to retest the day's lows, as sellers interpret the lack of upward momentum as a sign of weakness. Conversely, a sustained break above the intraday high of $7.79 would be technically significant, potentially squeezing short sellers and attracting momentum traders using platforms like the SoFi Invest app. This isn't just random noise. It's the market actively trying to price in two diametrically opposed futures for the company. The constant struggle around this pivot point suggests that large institutional orders are at play, with one camp seeing a deep value opportunity and the other methodically offloading risk. This is a far cry from the more predictable movements of a megacap like Apple stock. This is the raw, untamed nature of a company whose entire business premise is being questioned in real time. The macroeconomic environment remains the undeniable headwind. Every inflation report that comes in hot, every statement from a Fed governor hinting that the fight against inflation is not yet won, sends a chill through the housing sector. For Opendoor, this is a double-edged sword. Higher rates not only shrink the pool of potential buyers for the homes on their books, but they also directly increase the cost of the capital Opendoor uses to purchase and hold its inventory. Their business model is incredibly capital-intensive, relying on credit facilities to fund operations. As borrowing costs rise, their margins get squeezed from both the revenue and the expense side. This is a level of direct interest rate sensitivity that a company like Nvidia stock, which operates on the cycles of technological innovation, simply does not face. Investors looking for straightforward online investing opportunities often underestimate just how deeply Opendoor's fate is intertwined with the bond market. Any expected strength in the labor market or stubbornness in inflation data can erase a week's worth of gains for the stock in a single session. For anyone who isn't deeply familiar with the company, Opendoor is the leading name in a field called iBuying or instant buying. In essence, they use sophisticated data models and algorithms to generate near-instant cash offers for homeowners who want to sell their property without the traditional hassles of a listing, staging, and showing. The value proposition for the seller is speed, certainty, and convenience. Opendoor takes on the risk, performs some light repairs or updates, and then lists the home on the open market, aiming to sell it for a profit that covers their service fee, renovation costs, and holding expenses. During the housing frenzy fueled by rock-bottom interest rates, this model appeared almost infallible. A rapidly appreciating market acted as a safety net, ensuring that even if their initial pricing was slightly off, market lift would often cover the difference and guarantee a profitable flip. However, when the market slammed on the brakes in mid-2022, the model's fragility was laid bare. Opendoor was left holding billions of dollars in housing inventory that was depreciating in value, forcing them to take massive write-downs that decimated their financials and sent the stock price into a freefall. The 52-week range, stretching from a harrowing $0.51 to a more hopeful $10.87, serves as a stark reminder of this brutal volatility and the inherent risks of their business. This leads us to the future outlook, which is where the expectation versus reality framework becomes most critical. The bull case, the one that excites investors setting up a new individual brokerage account, is that Opendoor has survived its near-death experience and emerged much stronger. The argument is that the company was forced to refine its underwriting and pricing models with a level of discipline it never had during the boom years. They have significantly reduced their overhead and become much more selective about the homes they purchase. If the housing market simply stabilizes, not even booms, but just finds a floor, Opendoor is positioned to operate profitably with a leaner cost structure. Proponents believe they can capture significant market share from the legacy real estate brokerage industry as a new generation of homeowners prioritizes digital convenience. They envision a future where platforms offering investment help, like Schwab Intelligent Portfolios, might even include proptech innovators as a core growth component. In this vision, the current market capitalization is a fraction of its long-term potential. However, the bear case is equally, if not more compelling. It posits that the iBuying model is fundamentally broken in any market that isn't experiencing rapid home price appreciation. The razor-thin margins are simply too vulnerable to miscalculation or market shifts. Competitors like Zillow famously tried and failed at iBuying, shuttering their division after losing hundreds of millions of dollars because their algorithms couldn't accurately predict short-term home prices. The skeptical question is, what makes Opendoor's technology so superior that it can succeed where a data-centric powerhouse like Zillow failed? The bears argue that the holding costs, insurance, taxes, maintenance, and the cost of capital will continue to eat away at any potential profits in a flat or declining market. They see a company that is constantly burning cash with a difficult path to sustainable profitability. From this perspective, an investor might be better off putting their capital into established Fidelity mutual funds or even a high-growth name like Tesla stock, which, for all its volatility, has a proven and profitable business model. The risk of further capital raises and share dilution remains a significant overhang for Opendoor. This brings the entire discussion to a crucial point about the underlying market conditions. The company's success is inextricably linked to the behavior of the housing market, which itself is a function of mortgage rates. So I want you to weigh in on this. Comment below with your prediction. Do you believe the average 30-year fixed mortgage rate in the U.S. will be above or below 6% by this time next year? In conclusion, as we observe Opendoor Technologies oscillating around the $7.28 mark, it's absolutely clear that this isn't just another name on a stock ticker. It represents a high-stakes referendum on the future of real estate transactions. The common expectation is deceptively simple, that this is a leveraged bet on falling interest rates. It's a narrative of passive waiting, of holding on until the Federal Reserve provides relief. But the underlying reality is a far more strenuous and uncertain operational challenge. The true measure of Opendoor's future success will not be found in the minutes of a Fed meeting, but in the lines of its own income statement. It will be determined by the precision of its buying algorithms, the discipline of its inventory management, and its hard-fought ability to generate consistent profit from each transaction in a market that no longer offers a margin for error. The intraday tug-of-war we see today is the perfect embodiment of this conflict, a market deeply divided, trying to decide if Opendoor has crafted a resilient model for the future or if it is merely a relic of a bygone low-rate environment. The ultimate resolution of that question will define whether today's price is a historic entry point or a dangerous trap.